Hey guys, Ryan Reiffert here, San Antonio business corporate attorney. We're going to be talking about buy-sell agreements today. Business succession planning, really interesting topic, or at least interesting to an attorney. Certainly interesting if you're a small business owner as well, and all of your wealth is kind of tied up in that nest egg, and it's a business, it's not a pile of cash that you can sort of will and cut up willy-nilly. Before we get any further, I want to ask everybody to like and subscribe, drop a comment, let me know if there's another video that you want to see. Today we're going to have a special guest. We're going to interview him. His name is Sergio Jimenez. I've known Sergio for a while, several years. He's a good guy. He is a better golfer than I am, and which is not saying much. I'm terrible at golf. He's been doing this for about 15 years. He's a wealth advisor, certified financial planner. Recently opened his own shop, Jimenez Wealth Strategies. You can go to jimenezws.com. He started his career in California, moved to beautiful San Antonio a little bit later on. Has worked with some really big names in the industry in the past. Serves clients now as his own shop throughout San Antonio, Austin, Dallas, Houston, I believe a few in California and other places as well. So without any further ado, let's get into it. And there we go. So thanks everybody for tuning in today. We have with us Mr. Sergio Jimenez. Really appreciate him coming on to share some of his JD CFP advice with us. And what we're going to be talking about today is buy-sell agreements. So Sergio?
Well, thank you, Ryan. Thank you for having me here today. I'll let you know no one has ever introduced me as being a better golfer than them. So this is a first for me. But it's a pleasure to be here today, and we're going to discuss buy-sell agreements. Thank you for inviting me. Before we begin, though, I think it's important to have a quick little disclosure, which I know you had in front of the video. But again, this is going to be a general conversation about the subjects, and certainly not financial, tax, or legal advice. That's going to have to be more of an independent basis for each client. Everybody's different. But a little bit about myself. I'm about 15 years experience in financial services. I am a lawyer as well. That's a separate hat that I wear. Nonetheless, I am a certified financial planner. I've been in the industry for quite some time. Prior to having my private practice, I was the advanced planning consultant, advanced planning attorney for a very large insurance company, where I dealt primarily with buy-sell agreements and business succession planning, where I would coordinate with the attorneys and the CPAs and the advisors, all the multiple factors that go into considering a proper buy-sell agreement. And really, the buy-sell agreement, before we get into the nitty-gritty of it, is I would sometimes refer to it as a prenup. It's a prenuptial agreement for business. But not just that, it can be post-nuptial. A lot of the buy-sell agreements are done with businesses that are far past their initial stage. They're very mature businesses, so it can be both. But essentially, really, it's more like a prenup in the sense that you go through the different scenarios of what happens if we die, we retire, one of us wants to leave, and so forth. At the end of the day, it's a vehicle for peace of mind, right, where everyone is protected. And essentially, the company, the shareholder, the family, all of them can be protected. And there's also some good financial advantages if done correctly.
Perfect. I really like that description of it, that it's a business prenup. And a lot of times when I see people who have gone into business with a partner or multiple partners, and they decide they don't want to do it anymore, they want to go their separate ways, I sort of jokingly describe that as a business divorce. I mean, jokingly, not jokingly, but I mean a business succession, a buy-sell agreement is very much a business prenup. So that leads to the first question here, which is if you were going to give the simplest possible explanation of someone who knows nothing about this whole field, when we're talking about a buy-sell agreement, what are we talking about?
Yeah, so buy-sell agreements are often used in business succession planning where the business is owned by a relatively small group of owners who would otherwise have a limited market in which they would be able to sell their business interests. We call these the closely held businesses. Right? So really a buy-sell agreement is essentially a contract to buy and sell a departing business owner's interest in a business at some point in the future, usually upon the occurrence of one or more specified events, right? We call those triggering events. Such as what, right? So the most common ones, of course, is death, stockholder's death, shareholder's death. And I use shareholder loosely to mean any owner. It could be LLC unit member and so forth. So death is a big one, but also disability, could be retirement, voluntary or involuntary termination of employment. What does that could mean? I mean, someone can commit a crime and maybe disqualifies them if it's a professional service that requires a license. Death, we said divorce, bankruptcy, those issues that we can touch upon.
I've recommended that people do buy sells before. And one of the questions that I have run into is, okay, I already have a will, I already have my power of attorney, I already have my kind of, and you're familiar with the basic estate planning package, right? Mm-hmm. Being an attorney. Your will, your power of attorney, your physician directive, all of that. They say, well, why do I need a buy sell? Because isn't my interest in the business part of the property that I own? And isn't the will going to pass that?
Well, that's a great question. And I get that often as well. So first and foremost, I encourage everyone to have their wills and trust and all of their estate planning documents in place. And that's extremely important and crucial. In fact, it should be coordinated. Everything should be coordinated with the estate plan. But the buy-sell agreement is different, and it's still necessary. Remember that a buy-sell is a contract between two parties. And at the end of the day, it's there to protect the other shareholder. It is a legally binding agreement that can bind the estate. For instance, if you and I, Ryan, we start a business and then we have a contract, a buy-sell agreement, let's say, but we create a contract amongst ourselves, and then I go and the very next day and I create a will, and in the provisions of this will, I have terms that completely contradict everything that you and I agreed upon. That's irrelevant. We have a binding contract, and you can enforce that against my estate. So that's the reason why buy-sell agreements are so important, because of the legally binding nature that it protects all of the parties.
That contract can be that contract can be enforced against that estate all day. You can't waive a contract by subsequently making a will. Mm-hmm. You hear a lot about buy-sell agreements from folks on the life insurance side of things. So why is it that this is something that is kind of so often coupled with life insurance? What is it about that makes that combination tick?
Yeah, absolutely, Ryan. So life insurance is commonly paired with buy-sell agreements for a good reason. If you think of the buy-sell agreement, there's really two parts, and it's really important. The first part is the actual contract, where corporate counsel helps negotiate the actual terms of the legally binding agreement. But the second part of the buy-sell is what we call the funding. And that is how to pay for it in layman's terms. For instance, if we have a business, okay, and let's suppose for right now, for this example, that's valued, let's say we value it at $1 million, 500,000 for me, 500,000 for you, okay, and we come across this agreement to where if you die, I'm gonna buy from your estate or whomever, spouse, your shares of the business, the 500,000. That's all great. But how am I going to pay for it? Let's suppose I don't have 500,000, or maybe the business doesn't have the luxury of pulling from cash flows and buying and paying 500,000 for anybody, for any shares. So what the life insurance does, it provides that liquidity, it provides the cash needed to make the buy-sell contract actually work. The best example that I can give you is what we call a cross-purchase buy-sell agreement. That's probably the simplest of all the buy-sell agreements. There's multiple variations of that one as well, but let me give you a very simple example. So let's suppose again, you and I, we have a business, right? And we sell widgets, whatever widgets means actually. So we have that business. There's only two of us. And we come across that agreement. We do a cross-purchase buy-sell agreement. So let's suppose in that scenario, we do an agreement where I die, okay? So I die, and we insure each other. So I insure you for $500,000, and you insure me for $500,000. And let's suppose I die first. So you would get the death benefit from the life insurance policy. That $500,000 death benefit would go to you. Let's, for our purposes here, let's say we followed all the protocol and you receive that death benefit completely income tax free. So $500,000, you pay no taxes. When I die, let's suppose my wife inherits all my shares of my business. So in that scenario then, she receives something we call stepped up basis that it gets a little technical from a tax perspective, but she inherits my shares. She's not paying any taxes, but there's something we call basis will affect later on because she will then sell those shares over to you. And you use that money from the life insurance to buy those shares from her. So she sells and you buy. And if done correctly, and we plan this out, she will have little or no capital gains tax. And at the end of the day, that the end result would be that you keep 100% of the shares, 100% of the company, and my wife walks out with income, right? With actual cash that she can use for whatever purpose. And so that's where the life insurance comes in. Now, variations are pretty significant, especially if there's more than two shareholders. There's 3, 4, 5 shareholders. That cross-purchase example that I gave you doesn't even work anymore. For instance, if we have 4 shareholders, now we need 12 life insurance policies, right? A has to insure B, C, and D. B has to insure A, C, D. C has to insure A, B, D. So you can see how quickly that gets a little ridiculous. So what we end up doing sometimes is that we use the corporation, and many times we call those redemptions, and we can talk about this a little bit further, but redemption to where the company redeems stock and the company buys life insurance for its shareholders, kind of like key person policies. Excuse me. So there's multiple examples of how that could work. In any scenario, though, we've done many cases where we do separate entities and so forth. But life insurance, to answer the question why, at the end of the day, it's important in the buy-sell agreement whenever appropriate, is that it gives you the liquidity and it gives you the capital to make sure you can actually go through with the actual legal agreement. And that's important.
Basically a solution to the liquidity problem, right? That if one of the partners dies, the business doesn't necessarily have free cash flow on hand that is equal to the full value of the business. Very few businesses can do that. Can just pull out of their pocket cash that's equal to half of the business. So this life insurance solves the liquidity problem. All right, so my next question has to do with the deductibility of life insurance from a tax perspective. Now, of course, a lot of times when this is provided as part of a benefits package, it can be deductible, but in the buy-sell context, is life insurance ever deductible?
I absolutely, Ryan, in the sense it's this. Here's the thing. Here's how it works. This is the most confusing part for most people, just so you know, including tax professionals. And the years, especially when I worked for the insurance company, I would say almost every single day I would have a conversation with an accountant about this, because it's confusing in the sense that a lot of people confuse the life insurance, the way the tax treatment works, with, let's say, disability insurance, which is different than health insurance, which is separate from long-term care insurance. And they all have very peculiar sections of the Internal Revenue Code. But allow me to start with this general premise, right? Generally speaking, life insurance premiums are not tax deductible. There are some exceptions, and you'll hear this from a lot of life insurance people. They use something called Section 162, which is an executive bonus, which is the ordinary necessary business expenses. And that, to a certain degree, that's true. It works really in non-shareholder policies. a little bit beyond today's scope of executive compensation. But for our purposes today, when it comes to buy-sell agreements and the way these buy-sell agreements are structured, it's really not tax deductible for almost the overwhelming majority of the times, unless we also include some type of other executive compensation into the mix. There's a section out there, 264A1, that specifically says that life insurance is not deductible. The premiums are not deductible if the taxpayer is directly or indirectly a beneficiary under the policy. Okay, so that could be a lot of different ways in which that can be applied, but for the overwhelming majority of these buy-sell agreements, it is not tax deductible. Then if you think about it, that makes sense, because if you were to deduct the premium, so it's completely pre-tax, and if it's a cash value policy, then it also accumulates in a tax deferred way. So you pay no taxes up front, it defers completely tax-free, and then if you die, you get the death benefit also tax-free, or you may access the cash value cash-free. It would be an enormous loophole, and it just doesn't work that way. You will pay your taxes somewhere, whether upfront or in the back, and the life insurance, the tax benefit is on the back. So that's important. Where I see a lot of people wanting to deduct it is in the corporate-owned life insurance place, where the corporation buys the life insurance for the owner. This is really, it's very different when you talk about shareholders and non-shareholders. But today, since we're talking about buy-sell agreements, we're talking directly about shareholders. And this is a type of plan we call a redemption plan, where we discussed it before, to where the corporation redeems the shares of the owners and try to do the buy-sell agreement there. Again, same thing, where the corporation is the owner and the beneficiary of the life insurance policy. Section 264 will disallow the deduction. And quite frankly, the way it actually works is that the company does not deduct it, but they have to report it. And there's actually a form 8925 that they have to report it every year. There has to be notice, consent, and there's sort of requirements to make sure that the death benefit is tax-free. Okay. So, and then when it comes to the tax treatment, the other thing that's really important in the planning, and this is where I think most people stop. Most people that are not really that don't do this on a daily basis, is that sometimes you can structure, and that's the easy part, to structure the death benefit into the company tax-free, but then how are you going to get that money out? Okay, I see a lot of people putting death benefits on C corporations or even S corporations, and they're not very friendly to life insurance. A lot of people think they are, but they're not. Then how are you going to get the money out from the entity to the shareholders? There's ways to do it advantageously. And otherwise, you may find yourself to where you get the death benefit and the company doesn't pay taxes, but then you have to push it out to the shareholders, and all of a sudden we have a dividend. We've essentially made a taxable distribution to shareholders if we don't do this correctly. So that's really important. At the end of the day, it's really important to have a good team behind you. So you have your accountant, you have your corporate attorney, you have your financial planner, all of them taking a look at this tax situation and the corporate situation, how it all goes together. But there are some really good benefits on the back end of the buy-sell agreement. Not only that, and I always want to put this with an asterisk, that there could potentially be some lifetime benefits if you're using some type of what we call cash value life insurance, in which it accumulates for you as it goes. There are some great benefits to having the corporation own it as well, because it's an asset in the balance sheet that can be used tax favorably as well for other projects. That's a little bit beyond today, but I think definitely the tax question is extremely important. I would not do the buy-sell agreement if you're looking for tax deductions, so that's not what it's there for.
Okay. So obviously a very complicated topic, and don't try this at home kind of a thing.
Yeah, definitely don't try this at home. This is not a do-it-yourself project. At the end of the day, the role of the CFP professional, certified financial planner, is to map out the scenarios and work in conjunction with the corporate attorney, the CPA, enrolled agent, or other tax professionals to make sure that it's all one comprehensive plan. But also to look at it from a holistic point of view and look how it could affect you in other areas, right? Because it's your estate planning that is coordinated with your estate planning, your estate planner. I think of the example when I've gone to the doctor for whatever issue, and then they start asking me questions to something that I think completely unrelated. But sometimes you don't know what you don't know. They're asking you something because the doctor may see that maybe if you do this, it might affect you over here, right? Or the wholly different area. So when we talk about buy-sell agreements and buyouts and doing all these things, sometimes it has effect in other areas, many times in your estate plan. Sometimes if you don't structure this right, depending on the size of your estate, and we include life insurance and everything else, you can find yourself in having a perfect buy-sell agreement and then find yourself in a potentially estate tax situation if not done correctly. So that's the role of the CFP, to put all these pieces together into one comprehensive plan.
So get your entire team involved. Okay, so let's talk about the next question that I had, and we'll go back to the example of, say you and I own a business, we have a buy-sell in place, we take out life insurance on each other, so there's some liquidity, we've crossed that bridge, we figured that out. And as any closely held business, it has some revenue, it has some expenses. We have our kind of basic financials, we understand them. How do we figure out what my half of that business is worth after I pass? What's these are not publicly traded companies where we can say, one share of Ryan Sergio LLC is worth $20. And so you have 100 shares, so therefore this is your payout. It's a slightly more complicated matter with a private company. So how do we do that?
Yeah, Ryan, so valuation, that is definitely the point of contention in most plans. There are usually three methods, right? We call it peg the value, a formula, or an actual valuation. And before I get into those though, it's going to be really important to address the fact that regardless of what it is, there's no right way to do this. There's multiple ways to do this correctly, but what's really important is that either the value or the way value is determined has to be negotiated up front during the lifetime, not at the death. The last thing you want to do is try to negotiate values with the widow or the heirs. It's just not the proper time to do it. This has to be done up front. There has to be no question as to either the value or how the value will be determined. And this is to be negotiated with people, with the shareholders up front, with cool and collected minds, and not in a place where the heirs need cash right away. It's just never a good idea to do that. But going back to your question about valuation, there's really three major methods and variations within them. There's one that we call pegging the value. And what this is you put a specific value. Hey, we're going to say that the business is worth $1 million, right? Whatever it may be. So you put the specific value of the business. And this typically works well when you don't have family members. It's not a father, son, daughter type of business. You don't have immediate family members. You don't want to peg the value with family-owned businesses when you have generations, because when it goes to the next generation, you may be asking for a challenge in the IRS as to potentially having masked gifts if it's grossly undervalued or overvalued for estate tax purposes. So it's usually not a good idea. When you have unrelated parties, that's when pegging the value works best. The pros is that it's very easy. You do a specific value, and if it's reasonable, the IRS will usually honor it. I just did one, for example. I just finished one, where it was a company up in Houston, and what we did is that they have actually 4 different entities, and what they ended up doing is they ended up pegging the value at $30 million. It's a very good company, so $10 million each shareholder. So what they did is that with counsel created a separate company just for the life insurance, and that was for tax purposes. And we wanted to have a partnership taxation. It just doesn't work well with S corps and C corps, so we did a partnership taxation, but they pegged the value at $10 million per shareholder for all of the entities. So this new entity would receive the cash from the death benefit and buy the remaining shares from the deceased shareholder. And that was very good in the sense that it was very easy to determine. The cons with having a specific value is that if you don't revisit this every single year or very often, you can find yourself in the buy sells to where now 10 years later you peg the value at 10 million. Now the business could be worth 30 million. So you're essentially, the company is getting, or the heirs are getting, a very deflated value, right? So you have to keep up with it. The other way that I've seen it is usually a formula, and this varies by the company, but it could be anything from price to earnings, book value, whatever it is. It varies heavily on the type of business. So services business may be different than a service business. So whatever, doesn't matter what it is, as long as it has to be a formula that it can be easily determinable. The last one that I've seen is the valuation. The valuation is where you say, whatever it's going to be, we're going to do a formal valuation by a certified person, and you can look at the credentials, experience, etc. And the company will hire someone to do the valuations. And I've seen provisions in the agreement where it says the shareholder can also hire their own certified business appraiser. And they can, if for some reason it varies more than 10%, 15%, 20%, whatever, they will get the average of the two, something like that. So you can do a valuation. Regardless of what it is, though, it has to be very, very clear, and I cannot stress that enough, because that is usually the point of contention, and that has to be very, very clear.
The last question that I had, and then if you want to go back and revisit anything or so forth, is, and we touched on this at the very beginning, was what about exercising a buy-sell agreement in an event other than death? And by this, I suppose we would include, not only a situation like a divorce, but as well, say we just decide we want to go our separate ways, but there's a bunch of value in the business, and we carve that up. Are there unique considerations to those situations, or are they pretty much the same and the triggering event is just slightly different? Or can you speak to that a little bit?
Yeah, absolutely. So corporate counsel really needs to be heavily involved here, right? Because the financial planner kind of looks at the whole situation, but there's a lot of legalities in there where corporate counsel, such as yourself, would come in. But there are other triggering events: disability, retirement, selling to third parties, bankruptcy, divorce, all those things that happen in life. For instance, disability, many times that's insured as well. Sometimes you can do a disability insurance policy that covers the person, especially if they have to be an employee of the company as well, especially if they provide a real service to the company. That's where disability comes in. And just as a matter of record here, it's really important that the definition of disability is congruent in the document and in the disability policy, so they are congruent with each other. Retirement, what happens if somebody wants to retire from the company? There should be provisions that are on there, and that's where corporate counsel comes in. The time where the financial planner also really assists with that retirement in the shares as well, is especially if there's in an insured buy-sell agreement, if there's cash value life insurance, because now you have an insurance policy that has money in there. How are you going to distribute that to the shareholder? I've seen cases, I personally worked on cases to where it was pretty sloppy the way it was done, and by the time it was to distribute a policy to the shareholder, that distribution, that passing those assets to the shareholder, would have been a taxable event, and that could have been easily avoided with some proper planning. But other things, divorce, bankruptcy, there's just so many different things that can happen, and this is all kind of tied with the right of first refusal, right? You see that quite often in documents, having a right of first refusal, which is a little bit different. It's not quite a buy-sell agreement.
Right, and I'm often surprised by the number of bylaws and operating agreements that don't have those things like the right of first refusal that you were referring to, which is in my opinion something that ought to be in every one, but still for the purpose of something like a divorce, doesn't necessarily solve your problem, right? Because a right of first refusal says, if I'm going to sell it to someone else, then you get to match. But if I just want to hold on to it and be a dog in the manger and be a pain in your side, Well, the right of first refusal is a dead letter in that case. So you
Yep.
need something a little bit stronger, like a, buy sell or push pull or something like that.
Right, yeah. So the right of first refusal, as you mentioned, it is very different than a mandatory buy sell provision. So, give you an example, right? You gave a perfect example of the right of first refusal, but a buy sell provision has mandatory provisions. In the example that we just had before, where I died and my wife inherited the shares, now you inherited the death benefit, and you were going to buy those shares from her. It's not where my wife has the option of selling you the shares. This buy sell agreement has mandatory provisions saying she will sell those shares and you will buy. That gives certainty to the agreement. That's the major difference. And because of that, because it has those mandatory provisions, and because companies are these are closely held companies, not a readily available market, it's a unique asset. That's something, Ryan, that you're very familiar with. We call that equitable claims. In other words, that for laypersons, that means that if, let's say, one of the parties is refusing to buy or sell, the other party can go to court and say, I want this contract to be fulfilled. I demand that this person sell me those shares at this price, or this person buy these shares from me. This is what we call an equitable claim. We seek equity. So it means that the contract can be enforced even upon the death of one of the shareholders.
Well, you kind of anticipated my last question, which was, if I'm a business owner and I'm thinking about a buy sell, what's my takeaway here? What's my first step?
So the takeaway I would say is that the buy sell is really necessary, and it's a conversation that needs to be had. A lot of people don't want to have these conversations because they just think of death. And yes, death is a major triggering event, but there's a lot of really good opportunities too for business planning in general, in lifetime planning. But it becomes even more important as businesses mature, as businesses have assets. And now we want to take a look at exit strategies and how to do that effectively. I would say that the takeaway here is to get your team in place. Have your really good corporate attorney, have your certified financial planner, have your tax professional, CPA, enrolled agent, other tax professional, that the collaboration can begin. All these parties are working together to make sure that you have a good comprehensive plan.
Well, I think that's a great summary. And again, Sergio, thank you for coming on. Really appreciate you taking the time. So you can find Sergio's website at jimenezws.com. That's JIMENEZWS.com. And you can find my website at ryanreiffert.com or social at lawreiffert. Again, take a minute, check out both of those websites, give a like, give a subscribe, send a message or a comment if you want to see another video for next time. So thanks everybody again.
Thank you.